I just want to share with you something I just learned about. This is a great way to reduce your taxable income and save money, and it's not even too late to do it for the 2018 year. I'm going to share it with you in video form. So think about it this way. Here's your taxable income. If you had any write-offs, great, but that is what's left. That is your taxable adjusted gross income. Assume the IRS is going to come along and take a third of it, or whatever that chunk is. For ease of demonstration, I'm just going to use about a third of the taxable income goes to income taxes. So let's say that same amount of taxable income, if you decide to invest in this conservation easement, so you got some cash out now, you're going to pay to the conservation easement syndicator. And that firm makes the donation of the potential future value of that property, which is like a 4 to 7 times multiple of what is paid for the property. So the write-off you see right here is 4 to 7 times your payment out. So I added 5 little rectangles here. So that's a 5 times increase. So that 5-time increase reduces your taxable income. So I pulled it over to that rectangle, and you see that that write-off lowers your taxable income. So now let's say you still have income taxes coming out at about a third of your taxable income. I mean, if you're lucky, your taxable income will go down significantly enough that you're actually going to get into a lower tax bracket. So instead of taking out a third, maybe it takes out a fifth or a fourth. But this is just assuming you didn't drop a bracket and you're still losing a third of that taxable income. So there it goes. So let's do that comparison of the cash out in both of these scenarios, with and without the conservation easement write-off. The first scenario with no write-offs, that was your taxable income. That's the cash that went out. Here, that's your taxable income, a lot lower. And your cash went out to make the investment, but a lot less went out to the IRS. So the beauty in this is if you combine those cash out squares, you're either paying a big chunk to the IRS or a small chunk to the CE firm and a smaller chunk to the IRS than you would have otherwise. And you have a tax savings. So the way the math works is it's typical to save 30 to 50% of the value of your investment. So, I mean, if you drop into a lower tax bracket, it could save you even more. But let's say you made the minimum investment of $25,000 to the CE firm, you could save like $10,000 to $13,000. And it's early November now. It's not too late to take this deduction. For 2018, you'll know exactly what the numbers are before you agree to do it. You talk to the advisors, they'll tell you, put out this much, this is the property you're going to be investing in, this is what the CE firm bought it at, this is the write-off they're taking, because if they had developed it for oil drilling or something, it would have been worth this. So that's your share of that big write-off. When it's donated, that will determine how much less taxes you have to pay. If you're interested, please look at tricksoftheRich.com or contact Frontier Wealth Strategies in Walnut Creek, California. Thanks, and I hope it helps. Bye.